Good morning, everybody. Welcome to the Flow Show. Bran, you've just said you're not sure what to do today and hope this show will give you a pointer. I was going to ask you what to do today because I don't know what's going on either. But there we go. We're all in the dark. But I'm sure we'll find some wood among the trees, as they say. Stel is sitting on a beach. With his laptop open, so he's enjoying the sun. Kay's still taking some time off, so just me again today. And we got there in the end. It's Friday today. I hope you've all had a good week so far. If you have, don't blow it all today. Right, let's get stuck into it. And we've been hearing from PBOC's Liu about the economy, saying that it needs time to return to normal after the pandemic. China has not seen deflation and there's no deflationary risks in the second half of the year. CPI could go lower in July and rebound in August. Obviously, we've got a flat reading at the last number. The PBOC has ample policy room for dealing with unexpected factors. To push the real economy, or they're going to push the real economy, borrowing and financial costs lower, i.e. hinting at more rate cuts. Speaking on FX, said they will prevent sharp fluctuations in the yuan. They cannot manipulate FX rates as that will be counterproductive. Short-term yuan cannot be accurately predicted. FX rates could go up or down in the short term. The yuan has depreciated somewhat, but hasn't deviated from the fundamentals. So that's a little bit of easier comments on yuan move so far. So that keeps the potential to see yuan pairs moving higher, dollar yuan moving higher. For now, we're under the cosh of what's going on in the dollar mainly, hence why we're continuing to see weakness in dollar yuan. Again, I'm still not quite ready to look at picking it up again on the long side, particularly with what's going on in the dollar at the moment, because it is a bit volatile. Coming over to Japan, a bit of data out of Japan overnight. Industrial production coming in worse than expected, minus 2.2%. Capacity utilization down as well. So it's another bit of a weak number on top of what we've seen already this week. Now, there is some news, further rumours about a tweak to the Bank of Japan and what they're doing. And Yomiuri Press in Japan said that the Bank of Japan is likely to raise its fiscal year 2023 inflation forecast above 2%, which would be quite a significant move because even at their last forecast, they had it coming in below 2%. So a move above 2% in their forecasts would be an indication that they are seeing inflation pressures and maybe things won't dip back as far as they expect, thus raising the prospect of them moving out of easing. It remains to be seen whether they do that or not. We're still bereft of any BOJ talking heads. I did wonder why they weren't popping up left, right and centre, particularly in Parliament, as they tend to do. But then I checked it out and I forgot that Parliament session ended, I think the 22nd of June. So their Parliament is closed probably until the autumn, hence why they've not been appearing there. But even so, we still haven't heard from any BOJ heads for quite some time. They will know about the rumours going on, mark my words. So they'll be watching the press, and the fact that they haven't come out to quash any of these stories so far might be telling. They're not the same as other central banks. You're not going to hear from them 30 times a day like we do with ECB and Fed heads, but still their silence is notable at the moment. And if these rumours of a tweak in July continue, and that's not going to happen, I would expect them to come out at least, or UEDA to come out and at least offer a few hints as to what they may be doing, like he did before the June meeting, which pretty much stamped over any expectations for any changes there. But anyway, we haven't heard from BOJ members, but we've heard from ex-BOJ members. Hayakawa said the BOJ will tweak yield control this month. Always take what former exes say with a pinch of salt. In other central bank news, RBA's Lowe will not be reappointed as governor. Likely one of the reasons is the hot mess he got into a few months ago. Deputy Governor Michelle Bullock will be taken over as governor and will serve a 7-year term from the 18th of September. Coming over to some data, and for those who trade the stocky, Swedish krona CPI came down, not as much as expected, 9.3% versus 9.1% expected, but lower than 9.7% prior. Their CPI at constant interest rates, which strips out mortgage rates and what's going on there, came in again higher than expected, but still a drop, 6.4%. Sticking to inflationary numbers, German wholesale prices had another drop, not as much as expected on the month, but a much steeper fall year on year. So more deflation, well, I won't call it deflationary, but disinflationary numbers for Germany there. That's going to feed into CPI numbers down the line. Coming over to the ECB, we got the latest minutes and a few headlines from that. It was seen as essential to communicate that monetary policy still had more ground to cover. It was argued that market participants would be surprised by the upward revision of inflation. Well, none of us were. A broad consensus supported the 25 pip hike. There was emphasis put on the merit of sticking to a data-dependent meeting-by-meeting approach. As we know, QE was ending at in July. Now, one thing they said was that the level of peak deposit facility interest rate, as well as its duration, as embodied by the forward curve and reflected in staff projections, could be judged as insufficient to bring inflation back to the medium-term target. So a lot of gobbledygook sounding stuff, but basically saying that where they think a terminal rate is in their forecasts is likely not enough to do the job. So that's a hawkish slant on that side. The Governing Council should stress that fiscal policy needed to be tightened. Well, as we heard from draft meeting minutes or whatever, Europe is going to look to end energy subsidies. So that will fall nicely into the ECB's path. Inflation was still projected to remain too high for too long, calling into question whether it was returning to target in a timely manner. Upside risks to the inflation outlook were judged to still prevail. So obviously that's the minutes from the meeting. I don't expect that the ECB will have changed their tune. What we have seen, as mentioned, particularly yesterday, was a bit of a pull down in terminal rate expectations for many central banks on the back of the US data and what that's done to Fed expectations. So Bank of England peak rate has been pulled down slightly, ECB peak rate has been pulled down slightly. What all these central bankers won't, or what they will do, is they'll be coming out to reinforce their rhetoric. They will not want the market going too far the other way, easing financial conditions by putting down on rate hikes and things like that. So we've got a big risk at the moment that we get some of the big heads, the Powells, Lagardes, Baileys and whatnot, coming out, and just if we see more of these rate expectations dropping, coming out and stamping their foot down on those, which could cause obviously markets to go the other way. So be prepared if you're in positions, if you're riding with these moves at the moment. Know your risk is that a big fat central bank foot could come steaming down on top of you. Over in the UK, PM Sunak, he approved a report by a pay industry body, a review on public sector pay. He's taken that advice, and so public sector pay will be rising by 6%. That is now going to come into effect for things like the NHS workers, or some NHS workers, teachers, that sort of thing. So a lot of strikes have been called off on the back of it, and those pods will be getting 6% pay rises. Now that has two effects for the Bank of England. One, it means we're going to get a little pay boost in the jobs numbers coming up. We already know that public sector pay was running at 5.8%. So we're probably going to have to wear through that pay increase coming in. But then it could also mark a top for public sector pay numbers. And then we see the numbers obviously dropping back after. As I say, for the BOE, that will take away a big chunk of inflationary pressure. There's some 5 million public sector workers in the UK. So it's no small beans, this pay rise. Usually pay rises in the public sector run between 1% and 2%. So we're already at lofty levels, and those lofty levels will go a bit higher. Now, how they're going to pay for it has been the question. They're not going to raise taxes. They're not. What they're basically going to do is cut other services. So they're not going to increase borrowing either. So as they give with one hand, they'll be taking with another. We'll wait to see what the moaning and groaning comes from that. Now, if we want a clear signal on the top of UK inflation, when the top is in for UK inflation, you've probably just got it from the OBR, which is the Office of Budget Responsibility. They make a lot of government forecasts or financial forecasts. I call them the Office of Bodged Responsibility because they couldn't predict the sun coming up, as far as I'm concerned. But the head of the OBR said he's seeing inflation pressures becoming more embedded in the UK economy. So if truth be told, and their record for forecasting is anything to go by, we have seen now a top in inflation, and we'll probably see it dropping thereafter. So just bear that in mind for the PPI, the CPI reports. I think we get one of those next week. So yeah, we'll keep an eye on those numbers there. I still think personally, there's a chance we see CPI pulling back this month, and I mean by decent numbers. But I think from August is when we really see CPI pulling back. But we'll go data by data, as they say. We are data dependent. All right, coming back to the US, and the second round of inflation numbers via PPI came out. Again, a bit like CPI, coming in softer than expected. PPI in a month, 0.1% versus 0.2 expected. That was an increase, though, over last month. But the year on year, take one of the core measures, if you like, 2.6% was expected to be unchanged at 2.8% in a few calendars. So that dipped back. Headline PPI as well, coming in softer than expected, 0.1%, getting very close to a negative number on that one. So pretty much looking the same direction as CPI. So there wasn't too much to make of that, although it did add to what we'd already seen in terms of the dollar and yields. But I think what we've seen now is the market perhaps gone a bit too far, particularly in dollar yen, and we'll look at that in a moment. But certainly I wouldn't call that a shock. This would have been a shock, or not a shock. This would have been a bit different in the market had CPI gone up or been a bit stickier, because this number's coming down would have suggested that is not going to last in CPI, and CPI would catch up eventually. Jobless claims was expected to jump to 250. It came in another low one, 237. So still no problems in there, no red flags at all from the jobs market on that front. We have some Fed heads out as well. Daily following Barkin in saying that it's too early to say we have declared victory on inflation. We must do enough to get the rate to a sufficiently restrictive level. It's hard to say whether wage growth is going to lead inflation down. We want to start heading towards a neutral rate as we approach 2% on inflation. So she's saying that if we're getting properly on the path to 2% and close to 2%, that's when she wants to start bringing down rates. We could be there in a couple of CPI readings, and then that's going to get the market going all dovish about cuts. Fed's Waller said he supported a pause in June, then favours raising rates in July at the next meeting. Says we're likely to need 2 more 25 pip hikes this year. September for him is live for monetary policy. We'll need to keep policy restrictive for some time. We've yet to see if the improvement in inflation will be sustained. Now we're losing one of our favourite Fed members, Bully Bullard. He's leaving the 14th of August. He's off to pastures new, so we will be losing his dulcet tones from things. He's one of the most hawkish currently on the Fed board, or in part of the Fed. So he's off. We'll see who takes over. Looking at some spending data, I mentioned the Amazon Day sales on the first day. It was a 2-day sale. On the second day, July 12th, consumers spent 6.3 billion, which was up 6.4% over last year. Now, across both days, 12.7 billion was spent, and that was 6.1% growth year on year. Now, there's going to be several different discussions on this. One of them is something that Steve likes to point out regarding the amount of sales and the value of sales, is that consumers may be paying more but getting less. My thought on that is slightly different. It's that consumers are still spending even if they're getting less. If they bought 2 fire sticks for $100 last year and they're only buying one for $106.40, marking that 6.4% increase, they're still spending that $6 more than they spent last year. So even if they're getting less, they are still spending. If numbers were down, if we were seeing negative spending numbers, that's a bit more worrisome for the consumer side of things. And again, I think we've got retail sales coming in next week. I just haven't had a look yet. So that's all I've got on the headline front for now. Let's get stuck into some of the prices. Dollar yen is looking quite volatile at the moment. We did have this breakdown overnight through 108, got down to my next support area I'd been highlighting in the low 137s. As you can see there, down into that fib, this prior area, and we had some moving average action going on down here as well. So a bit of a support zone. We got into it, but we've seen a pretty strong bounce so far. At the moment, this is looking like perhaps this move down is looking like it feels like a last blowout. This was the last blowout move lower, because this bounce is pretty strong. So could be a bit of profit taken in there, but we've broken back above 138 pretty swiftly. We're holding well above it now. So this is looking like a bit of an extreme move down here. Does that mean we're going all the way back up to the 140s? That remains to be seen. The first level we need to take on, as I pointed out yesterday, is this 139 area. Unless we get back above there, then we're keeping this move in play. 138 might become a bit of a pivot level. What we could find is that we build a bit of a short-term range now between 139 and somewhere down in the 137s. That's what I'll be looking for anyway. I'm sitting on my hands now. I did trade around in here. I was short at 139.20s. I got out of that yesterday. Went long 138s, got some off in that move up there, then got stopped out, flipped to reverse overnight, made 30 pips on half the trade. I had a TP at 137.50, made 50 pips there, 30 pips there, then got stopped on the other half for minus 30 pips. So a net zero trade on the short attempt. But now I'm flat, and I'm going to let this play out. I want to see what develops now. I want a bit more evidence before I start jumping in, because this could be a bit of a middling move here. As I say, 138 down to these lows is now the 2 levels to watch. If we trade in between, fine, we set up a bit of a range. If we start breaking one side or another to the downside, the move's not done. Are we going to continue? If we break to the upside, that suggests we've got this area, 137s, 138s, as a bit of a bottom. So for me, I'm just going to see what happens, let the levels develop, let the trades come to me rather than chase them around. Cable and Eurodollar haven't stopped though. We continue to make new highs. We busted through 112. I tried a 112 big figure trade scalp up here, managed to take 10 pips and then got stopped on the rest. So down a bit on that, pretty much the same in cable. We did get through 112 initially, and then we had a bit of a pullback this morning, but it's kicked right back up again. So there's no let up yet for this one, whereas dollar yen might be finding a bit of a bottom. There's no signs of this one really finding a top just yet. Just this little high, it may only be a few pips above this one, even just 1 or 2 pips above this one, but it keeps the pressure on. What you want to see is when you make a high is a lower high, because that suggests that the sellers are protecting this previous high. The fact we've broken it suggests we're perhaps not done yet. If we have a little dip down, we need to see what happens with this low down in the big figure 112. If it can't get down that far, then that suggests we're going to keep moving higher. What you want to see, as we've been talking about all week, and Gavin's done a good job in our chat room and he'll explain this as well, is you look for your higher highs to say the move's carrying on. You then look for your lower highs to make a suggestion that you're done making highs. If you get that, that can give you a bit of conviction that you're going to get a steeper pullback. But then you have to check what happens if you're getting short up here. Then you need to make sure what happens down here. So for the euro, I think that the signals, at least the price action at least, suggests we're not yet done with the upside. So that might need some more development before we can start calling tops. Cable, that's doing a bit similar. It's still making a, just ticking up a new high, but we've had, call it 4 attempts at trying to bust through 131.40. So it's holding off for now. As again, this is the sort of price action you're looking for, where you hit a level, you can't get through a level. We're not quite seeing the lower highs coming in from this just yet, but as I say, 1, 2, 3, 4 goes at trying to get through properly through 131.40s. It's not happening. So potentially a bit of a top coming in. Again, look at this low here. If we've got a top up here, this low needs to be taken out. If it's not, it keeps the pressure on the upside, keeps the move going. A bit similar to what you've got here, where you get a bit of action, it won't get through, but it's not really pulling back, and then off we go again. Where can this one go? Still looking at 131.70s as the main level for me on the top side. But we've been fighting a lot of levels on the way up. So if I'm going to have a go at that, if anyone's going to have a go at that, be mindful of which way the wind is blowing. If you're going against these moves, you're going to be fighting the trend. If you're going to fight the trend, bring your risk down, bring your risk management down. You don't want to put as much in. You don't want to risk too much on the trade because you are going against the trend. And that's something I always do. If I'm going with a trend, I'm happy to put more into it, give it a bit of a wider stop. If I'm going against the trend, then I'm going to bring my risk right down, reduce my trade size, keep my stops tighter, because as we saw with dollar yen, you can try and catch the knife at 10 different points and you would have lost at every single one of them. So pick your battlegrounds, and if you're going to try catching knives and picking tops, then keep your risk small. You don't want to do 5% in your account, 6% of your account in this sort of move. You don't want to do more than 1% of your account trading 10 times throughout this move. So you keep your trade small. That way it doesn't hurt you if you're wrong. Looking at some of the other pairs as well, Aussie dollar, that's having a decent kick up, but we're finding a bit of a brick wall again up towards 69. So again, if you're looking for your levels where you want to trade, picking your battlegrounds, we know we had the levels at 67, 68. They've been carved through and they were pretty decent levels. Well, you've got another one here at 69. which has been pretty solid area historically. This is but has now the potential, if we hold here, for a decent double top off this one. But if we break, we could be off to the races again. It could be 70 the next stop and another zone up there. But again, I'm not quite ready to fight it just yet, because it's been a strong move. We may show signs of exhaustion, but that needs to be proved. I want to see a bit of time passing at these highs. If we start seeing sort of this 68, 80s area, which has been a bit of a resistance area after we've tried 69s, if we see that similar action again there, then you've got a bit of conviction then to maybe try shorts if that's what you want to do. If you want to try and pick up on the dips at the moment, 68.60s is your level. We have an old level 68.50s. That might be a little bit of an extension point there. This is where you want to try catching a knife if thus you wish. But again, you want to keep it fairly tight. If we're below 68.50, likely we've made a decent top and we could be pulling back a bit further. Don't rule out a bit of profit taking today. That, you know, going back to dollar yen, there may be an element of that coming into dollar yen at the moment. Bit of profit taking. We've had 2 weeks of you know, 600 pip, nearly 700 pip moves in this. At the end of the week, traders might decide, right, I'm taking some of that off, protect my risk, don't want anything to happen over the weekend, and then maybe they come piling in on any rallies in first thing on Monday. So I wouldn't rule out some profit taking going on in this one. Stocks, you need to be watching out today because it's the start of earnings. Personally, I don't see that there should be any worries from earnings at the moment. Keep an eye on your big retail companies, obviously, because they will potentially flag any problems with the consumer. Things like banks, we've come through the banking crisis. There might be some drawdowns where banks have been laying out and spending to pick up some of these small regionals, you know, bankroll deposits, maybe something like that. That may be something that affects earnings. But otherwise, I don't see any problems. I don't see why we should see any big, huge collapses in earnings numbers right now. If anything, the banks, particularly the big banks, should report an uptick in earnings because of taking on all the deposits from those regional banks. So for stocks, you know, it's going to be a question of, you know, whether anything's good or really good as opposed to anything being really bad, and that's going to be supportive. But that all kicks off today anyway. And if you're in our chat room, the guys have put in the firms that are reporting today anyway. As far as stocks goes, we are banging around this 45 area. We're staying above the 45s for now. Bit of a level here, 45.16, bit of an old level. It's been on my chart for quite a while. It just goes back to this prior resistance point, April last year, just where we hit those highs up to the 46s, came back, and that's where the resistance came in. So we're knocking around that zone at the moment. Above there, it's up into 45.90s, 46s, and then this high up 46.33. But there's no stopping stocks at the moment, pretty much like dollar yen. But this one's been going on just a bit longer, going back to March. We've seen this rally going on. As I say, got a bit of a top coming in here. We've had a little spike through, but it's holding below. The pullbacks are very shallow. It's not really giving you much to grab onto in terms of dip buying if you want to get in. So you've always got to be careful. I don't like buying up near tops. The only way I like doing that is if buying on a break of a decent level. If I want to try and buy a top, I won't just jump in and buy here, because, you know, you're talking 10, 15 pips you're playing with between where you might get in at 45s and the highs. And yeah, that just goes against the grain, my risk management of buying it in tops. Coming across to metals, and we'll take a look at good old gold. Where is it? Oh, it's up here, isn't it? So not managing to make any more headway over the last day or so. Now we're again just finding this bit of consolidation going on. So when you get periods like this, when you get markets, they have a big move, then they have a little pause. You have to watch the price action, see what develops. So the downside is a little bit messy. We've had lows, we've had a little bit lower, then it's coming a bit higher and whatever. So to me, it's not very clear what's going on up here. To me, the door is open that we could get a bigger pullback, whereas the top side just becoming a little bit more defined around this 60 area, 63, 64s. Just several goes at having a go, can't get through. So a bit more defined up there. I want to see a bit more definition coming in down here, just to give yourself some confidence whether you want to dip buy or whether you want to rally sell. It's all about the price action going on there for that one. Let's have a look at a couple of your questions going on here. The weekly moving average at 112.50 looks like resistance. Is it 112.50? I thought I had that. I thought I had the weekly moving average at 111.84. Well, it might be another one. Let's have a look. Yeah, I've got the 200 weekly. That's what I was looking at yesterday, 11.84. So you've got the 55. Have you? We might have different moving averages, Mike. Are you doing exponential or simple moving averages? Mine are simple. So my 55 weekly is right down there. That might be the difference. Not too sure. Let's have a look. Yeah, Brand, just spoken about that. Bloomberg pumping the headline that was dropped during Asia time about the Bank of Japan potentially ranking up their inflation forecasts. I don't know why your 55's right up there, Mike. Mine's down here. Very strange. Okay, if you're in the chat room, we could have discussed it. So I'm not sure what your, maybe got different settings to yours than mine, but I shouldn't think so. It's a strange one. Yeah, I've got the 200 up there. You sure it's the weekly? Let's have a look. Might be a monthly. There we go. On the monthly, maybe. What have I got here? Let's just zoom in a bit. Yeah, so I've got the 55 at 11.93. I've got the 100 at 112.55. The monthly moving average, 112.55. Stuart, how can you join the chat room? Give me 1 second, my friend, and I will pop you a link, and you can use that link. And if you want to use that link, this is my own special link. And let's have a look. Oh, where is it? Just have a look at that link there, Stuart, because it will give you a discount to the site as well. But yeah, coming back to your, it is the monthly. So you're trying to catch me out, aren't you, mate? Yeah, the monthly. Good spot, actually. Gone through the, I didn't even notice that we had the 55 monthly up there as well. So I've got the 100 monthly as the moving average, not the 50. And I also use 55s, not 50s in my moving averages. I know there's not much difference between them. Some people like the 50. I've always used a 55. But good spot anyway. I've got the 100 right up there. So again, on a closing basis for this week, that could be important, much like I mentioned about the weekly. So you can just about see it in there. We've got the 200 weekly moving average at 11.84. If we close above that today, that's going to be potentially a decent bullish signal. What might happen is that might become a bit of a support point. So if you're looking to buy the dip, look at that moving average, because if we come in the next week above that and we find that it's support, that's a good, could be a good place to pick up longs and maybe continue riding it higher. But anyway, good discussion on the moving averages there. Right, let's have a quick look around some of the other things going on, and please feel free to put some pairs that you want to discuss or some assets you want to discuss in the comments there, rather than me blathering on my lonesome. Just looking at oil, it's coming a bit shorter, shall we? So oil, we're still trucking on. I've got a big area up here, 82.50. It's an old fib level. It's also been a previous decent resistance point. We have had a little extension above it back in April, but it really starts from around 80.50. That's been a bit of an on-off level. If we get up to 82.50, it might be a bit tempting for oil players to put an end to this move, or try and put an end to this move. Apart from further production cuts, this is still a bit of a strange one, because there's no real fundamental reasons why oil should be going higher. I have seen some headlines that China imports have been at really high levels. They may be stocking up, who knows, because manufacturing is just as weak over there as it is everywhere else. Or they could be in a bit of a midst of a pickup in manufacturing, hence why they've got such large imports. And we also know they're putting their prices up, as the NDRC said they were doing this week. But fundamentally, I'm still a bit mixed about what's going on in oil, because the fundamentals don't suggest that this should be bullish. In fact, quite the opposite. But if it ain't going down, there's only one other way it can go, really. Just having a look at what we've got coming up today in the data front. We've got the flash Michigan numbers, Michigan consumer sentiment numbers coming in for July. So keep an eye on those ones. Obviously, keep an eye on these inflation numbers, 5-year and 1-year inflation numbers. That's really what the market will look at. We'll get an idea of the consumer, how they're feeling at the moment. They've been a bit chipper of late, so they've been quite positive of late. We're expecting, where are we? Another pickup to 65.5 from 64.4 prior. So that may be maintained. If these inflation numbers start printing with a 2 handle, that's going to feed further into a Fed pause. But if we get that plus consumer sentiment going up, that's going to feed into the soft landing narrative that we've been trading quite a lot as well. But yeah, nothing else really to write home about on the data front this afternoon, bar that. So it could be a market mover, considering how jumpy things are at the moment. As always, need to keep an eye on them yields. We've come back down through still 7.82. We had a bit of a trend line coming in through there. We're now down below that. Looks really much like we're back in the box now. So for the downside, we need to watch this 3.7 and then 3.60s, because that's where we held previously over the last month or so. We've had a little run up to the 4%. We've given that up very quickly. So the market is settling down to what it thinks rates are going to be doing moving forward. I still wasn't sure about what this move to 4% was. It looked like it was a potential asset switch, i.e. some flows coming out of bonds, taking their money elsewhere, maybe going into cash. But I think part of this steep move down is that those CPI numbers have come in, and some in the market have gone, right, well, we'd rather park our money in bonds, because why not? If we're going to earn, if rates are going to peak up here, this is as high as 10s are going to go. We can park our money for 10 years at 4%. If the Fed start to bring rates down again to a neutral level, be it 2.5%, 2%, 3%, well, then rates are 2-3%, and you're sitting in there for 10 years at 4.07%, 4.08%. So I can understand the feeling of this move coming in, because remember, yields go up when bonds are sold, yields go down when bonds are bought. So this is people buying, whereas they were selling. And one of the only reasons you might want to buy bonds, as I say, if rates are peaked, is to lock in at a decent return. Very little risk sitting in a government bond as opposed to other assets. If you want to look at the shorter end, though, we've also seen a bit of a pullback, 2 years, maybe now starting to reflect where rates are likely to come down to initially. We had this bit of an area which was sort of our our rule of thumb for where rates might go to. We've obviously blasted through that because rates going to be holding into 5%, but the market thinking already 2 years out rates are going to be on their way down. As I said, the Fed will be watching these short-term bond moves or bond yields because they won't want to see the effect of their policies unwound too quickly. So for the rest of the day, I'm not sure what you want to look at. Be careful with this dollar yen because it is a bit volatile at the moment, and I would say I'm sitting on my hands. I want to let it do its thing. Euro sterling, I'm still nursing longs down here off the 85 handle. We're sitting pretty much bang in the middle of the range, recent range up to 86, 85, 86, knocking around in the middle here. So I'm going to see what happens with that. If we get a decent rally, maybe up to 86s, 86 and a half, I'm going to look to knock some out. I still don't think we're done with the downside, but a bit of pressure has come off with, as I say, those central bank or expectations across all central banks easing a bit, particularly for the Bank of England. Peak rate expectations coming down. So it's taken a bit of bullish pressure out the pound in this pair. It doesn't mean it's taken it out in the other pair. Oh, Rick, you want to have a look at EA? Yep, no problem, mate. We can have a quick look at that. I can tell you the last time I had a decent look at this one. Right, it was looking pretty clear for me. You know, we've got decent resistance up at 165s. That's your main line up there. We have nicked a little low below this 62.47s. So again, it's that situation where we've come off a high, just a slightly higher, lower high, lower low. So you probably might find we form a bit of a channel coming down off this one. Now you guys, you've been trading this cup and handle, haven't you? So you've probably got a bit more to say about it than me. So I don't know what this downward move means for your cup and handle. I don't trade the T sets myself, but this is just matching this off against something like Euro CAD. You know, we've got a bit of a difference between some of these Euro crosses where they can tend to move a bit of the same way. Now for Euro Aussie, Bullock is said to be felt like she's more on the dovish side of things. Hence why you might be seeing a little bit of a pickup in this one this morning, because she is a bit more dovish. So the RBA expectations are for them to now potentially stay on an extended pause. But obviously we need to see what comes from that further out. Bit of moving average action going on here. You got a bit of confluence up top with the 4 hour moving averages 55 and 100, and we got a decent bounce off the 200 moving average down there as well. So if we're not going to do much today, those might be your battlegrounds. They might be the edges for this one. But as I said, EuroCAD is another one we looked at as well. We are holding this move above the big 46.5 line. It has held a support on a test. We haven't had a retest. Got a bit of a level up at 47.5 as well, but get over that, and there's a bit of room perhaps maybe to get up to the 48s, 49s. Maybe up here is a bit of a push up into the 150s. But if we get up there, that would potentially define a decent range top. It was a decent double top back in May. Another test up there might make it a big longer term top. So again, bit of patience needed, but note your big levels. Have them on the pad by the side of your desk somewhere, or just put a bit of a thicker line in like I do here, and just keep them in mind. You can always wait. You can mess around in here, but then wait for your big levels and you crack them on now. Right, well, if you guys and girls have nothing else, I've certainly have nothing else. Been a bit of a busy week again, hasn't it? So I'm beginning to run out of puff. Be careful for the rest of the day. Be very careful what's happening in the end. I can't repeat that enough. Just to me, the picture's a bit muddy now. We've had big falls. We've had a bit of a strong bounce today. You don't want to get sucked in on either side thinking that's the end and we're shooting much higher. or that the downside is done. So be very careful today. If you have had a good week so far, then trade for beer pips. Don't try and ruin it in the last hour's last trading session of the day. Thank you ever so much for your support this week, and I'm sure some of the boys will be back next week. If not, then I shall crack on as normal, and we do it all again. So have a great weekend, everybody. Any problems, Stuart, any questions you have about the chat or anything, you can hit us up on site or whatever. There's an intercom button there, so please do that. Thank you for coming to the Flow Show. Have a great weekend, everybody. See you next week.